Hello again. Now we're moving on to the next chapter, and that is introducing the capital budgeting techniques. So these are the tools that we will use that will allow us to evaluate the cash flows that you calculated in the previous chapter. Okay, so here's a list of the techniques that we will be discussing. It's not an exhaustive list, but the first three are the most commonly used, and the profitability index does provide us with a lot of good information, so it is another good one to discuss. So we will go through and calculate each one of those. I'll demonstrate how you calculate payback, net present value, internal rate of return, and profitability index. So we'll start with the payback method. Payback method, kind of like the name implies, is you are just calculating how many years does it take to recover your investment. So how long does it take for you to get paid back from your investment? So here I've got two investments. I call one Project S and the other Project L. And you'll note there that each of them have a net investment of $1,000. So the question is, how long does it take for us to get our $1,000 back from each of these two projects? Now, one of the assumptions that we use when we calculate the payback is we assume that the cash flows occur evenly throughout the year so that we can have partial years as part of the payback. So looking at Project S, we see that we recover half of our investment by the end of year one, $500. By the end of year two, we will have recovered a total of $900, right? The 500 plus the 400. And so we only need to recover another 100 in order to get our $1,000 net investment back. So by a third of the way through year three, we will have recovered the full $1,000. So our payback, you'll see below on the bottom of the slide there, for Project S is 2 1/3 years. Project L, we calculate the payback for that one, and we see that by the end of the first year we will have recovered $100, and then by the end of the second year we will have recovered an additional $300 for a total of $400. By the end of the third year we will have recovered an additional $400 for a total of $800. And so again, keeping in mind that we have to recover $1,000, we will have to go a third of the way into the fourth year before we hit that $1,000 mark. And so our payback for Project L is 3 1/3 years. So if we were to use the payback method to determine which is the best investment, the criteria would be to choose that project that has the shortest payback. And so we would go with Project S as opposed to Project L, because it gives you your money back the quickest. What are the advantages of the payback? Well, it's easy to calculate. You can see how very quickly we calculate it for that particular project. It does give you some information as to the liquidity of the project. So, by liquidity, how quickly does it turn back into cash? So how quickly do you get your cash back? And then the authors of your text also talk about how it is a little bit of a risk indicator, although we have a lot better measures of risk than payback. So I wouldn't necessarily agree with that. So that's why I put it might be a very crude risk indicator. What they're getting at is that the longer you have to wait to get your money, the more interference you can have. The more likely something could happen that would possibly change the prospects of your project or something like that. So that's what they're trying to get at in terms of risk. Disadvantages of the payback, there's a couple of really big disadvantages, and so the bottom line is you do not want to use the payback in order to make investment decisions. primarily because of these two big disadvantages. First of all, it ignores the time value of money. So if you look at project A and you look at project B, and you see that they both cost $1,000, and project A has a 2-year payback, and it doesn't matter what the cash flows are after that. We can see that we get our $1,000 back by the end of year 2. But the same is true for project B. We get our money back by the end of year 2. So the payback for both of these projects is 2 years. But if you look at the cash flows, there should be a project that you prefer over the other, even though the payback doesn't have a preference between the two. Payback would just simply be both projects are equal. And if you need to put, tack on 3 extra zeros to those numbers to kind of make this example more dramatic, so suppose that were 900,000 and 100,000. I mean, which project would you obviously prefer? And you would obviously prefer project A, because project A would return $900,000 in year 1 as opposed to having to wait until year 2 to get the 900,000 like you would have to with project B. So if I had 900,000 in year 1 and I could turn around and reinvest that into other money making projects, I'd be much better off with project A than I would be with project B. So the fact that it ignores the time value of money is a big deal. The other disadvantage to the payback is that it doesn't consider cash flows beyond the payback period. And so here you can see you've got project X and project Y, and if you calculate the payback period for project X, you'll see that it's 3 years. It takes 3 years for us to get our $1,000 investment back, while it only takes 2 years to get our $1,000 investment back for project Y. So according to the payback, we would prefer project Y as opposed to project X. But if you'll notice, project X gives us this huge payoff in year 4. So obviously, if you were really to look at all the cash flows, you would prefer project X over project Y. But the payback doesn't consider any cash flows beyond the payback period. So that's a big downside for the payback. So the payback in general is not a good method to base your decisions on. Sometimes it's used for screening large amounts of projects, but frankly I don't even like using it for that, because the payback tends to bias you towards quick payoff projects, and a lot of times your most strategic projects may take a while before they actually give you a payback, and those are oftentimes the most valuable projects. But at any rate, it is used by a lot of companies, and its primary use is to kind of screen the number of projects that they're having to deal with, and kind of eliminate some quickly, and then they apply some of the other techniques that we're going to get into next. So next we have the net present value, and the net present value is, I'm going to get my pointer here, my laser pointer. The net present value, here I'm showing the formula version of the net present value, but what it's doing is it's taking the cash flows that you calculated each year for the project, and it's discounting it back by the cost of capital. So you ask, what is the cost of capital? The cost of capital is the cost of financing the project. If you remember, in our cash flows, we didn't take out any financing cost. We didn't take out any interest expense associated with maybe having to take debt out in order to finance the project. We didn't take out any equity cost. So the cost of capital represents the overall average cost of financing for a firm. And so we are going to discount the cash flows by the cost of capital, and in that way we are including the cost of financing in the analysis. So that's why I wanted to show you the formula, so that you can see that by discounting, that's what, that's, in other words, falling back on our valuation chapters that we had earlier, our minimum required rate of return on this project is going to be what it's going to cost us to finance the project. That's the minimum required rate of return. So if we take each of the cash flows, each of the benefits, and all the way up to year end, with year end being the end of the life of the project, so however long the life of the project is, and we sum up the present value of the cash flows of the project, and then subtract the initial investment, that's investment at time period 0, the initial investment. In layman's terms, you're taking the present value of your benefits, your cash inflows, minus the present value of your cash outflows, which is your initial investment, which generally occurs at time period 0. And then basically, if your benefits outweigh your cost, then your net present value will be positive. And that's what we'll see here. If the net present value is greater than or equal to 0, then we could accept. Equal to 0 would mean that you just break even. So really in the real world it would have to be greater than 0 to accept, but in theory if it's greater or equal to 0 we accept. If the net present value is less than 0, then you would reject the project, because that would imply that the project, the benefits you're getting from the project, doesn't even cover its cost of financing. So let's go ahead and demonstrate how you would calculate the net present value. So here I have a problem. We've got Rolex Enterprises is considering the replacement of one of its old drill presses. 2 alternative replacement presses are under consideration. The relevant cash flows associated with each are given. Assume that the firm's cost of capital is 15%. So 15% is going to be our discount rate, because that cost of capital again represents our overall average cost of financing for the firm. Okay. So we have 2 drill presses, or 2 alternative presses. So let's look at the cash flows associated with each of those alternative presses. So here we have, as you can see, press A. Press A has a net investment of $85,000, and notice both press A and press B have a life of 8 years. Okay, press B will cost $130,000. Now press A gives us an annuity cash flow of $18,000 a year every year for all 8 years, whereas press B, which is considerably more expensive, gives us cash flows that are mixed. So we have a mixed cash flow stream over the 8-year period. So what we want to do is calculate the net present value for press A, and then also calculate it for press B as well, and see which one has the higher net present value. So we'll go with press A first. Okay, so to find the net present value, using the net present value formula, we would take the present value of our net cash flows, our net benefits, and subtract from that our net investment. So looking at the previous slide, our cash flows were $18,000 a year every year for 8 years. So that's an annuity, correct? So we can just find the present value of the net cash flows by using the present value of an annuity formula, where the annuity payment is $18,000 a year every year for 8 years, and we're discounting at 15%. And if you look that number up in your present value interest factor of annuity table, you'll find that the present value of that annuity is $80,771. So now to calculate the net present value, we would take that $80,771, subtract from that the $85,000 investment in press A that we saw in the previous slide, and then we find in fact that we would get a negative net present value of $4,229. Okay, we would like to avoid this investment if we can. Sometimes we have to take on negative net present value investments, but if we can avoid it, you want to avoid it, because basically what this is saying is that if we take on this project, our firm will lose $4,229 in value. Well, what about press B? If you remember, Press B had this mixed cash flow stream. So you see it again here, but it was more expensive. Instead of $80,000, it cost $130,000. So now what we want to do is find the present value of the benefits and subtract the net investment up here. So here's our benefits, and again, our cost of capital is 15%, and so I'm discounting. I have to take each one back individually because I have a mixed cash flow stream. So I'm discounting year 1, 2, 3, 4, 5, 6, 7, and 8 at 15%, and then I'm just multiplying here to get the present value of cash flows for each year. So here's my present value of cash flows for each year through year 8. And then now that I have them all in the same year at present value, I can now sum them up and get my total present value of cash flows at $145,043. So now I can take this number and my net investment of $130 and calculate my net present value. And so that's what I have on this slide here. My net present value for Press B is my present value of cash flows at $145,043 minus my $130,000 net investment, leaving me a net present value of $15,043. This is a positive net present value, so the implication being that it covers all its cost, including its cost of financing, and even when everything is said and done, it adds an additional $15,000 plus $15,043 to the value of the firm. So easy decision, hands down, between Press A and Press B. We would certainly go with Press B since it adds value to the firm rather than taking away value from the firm. So how do we interpret the net present value? I kind of already did this as I went through, but basically, again, just to kind of reiterate, the net present value does represent the added value to the firm as a result of making the investment. Okay, so it's added value for the shareholder. The third capital budgeting technique that we want to take a look at is the internal rate of return. And so again, notice that this formula is very similar to the net present value formula. Okay, you got your cash flows each year that you're discounting. The only thing that's different, though, if you'll notice, is we're discounting by the internal rate of return rather than the cost of capital. Instead of K here, we've got the internal rate of return here. So bear with me here for just a minute. So what we're trying to do is we want to make this equation come true. So what we're trying to do is find the discount rate that gives us a net present value of 0. See how this formula is discounting all the cash flows by the internal rate of return, then it subtracts the initial investment, and it wants to come out to equal 0. So in order to find the internal rate of return, you have to use trial and error. And what you're trying to do again is find out what the discount rate is. What is the discount rate that gives you an NPV of 0? And then that tells you what the yield to maturity actually is on the project. It tells you what the internal rate of return is on the project. Then what you do, once you get that internal rate of return, you compare it to the firm's cost of capital. Okay, if the return you're going to get on the project is greater than or equal to the cost of capital, then the project is acceptable. If the internal rate of return is less than what it's going to cost you to finance the project, obviously you would want to reject it because you'd want to at least earn a rate of return as high as it would take to finance the project. So let's work through an example with the internal rate of return. Okay, so let's go ahead and go through an internal rate of return example. This is where I'm coming through on my promise that you get to do a trial and error type problem. So here we'll have a simple project. We've got a project that cost $1,000, and in return you should expect to receive cash flows of $500 in year 1, $400 in year 2, $300 in year 3, and $100 in year 4. Okay, so our objective again is to find the discount rate that will give us an NPV of 0, and that's the rate of return then that we would expect to earn on that project. So we just pick a number, we pick a discount rate, and so we'll see here on the next slide. Okay, I just chose 10%. Good place to start. I usually suggest starting at 10 or 15%. So we're going to try 10% and see what happens. So I took the cash flows from the project in the previous slide, and let me get my laser going here. So here I take the first $500 and discount it back 1 year at 10%, and again my tables I think go out an extra decimal than yours. And then I just multiply to get my present value of cash flows for year 1. Do the same thing for year 2, 3, and 4, discounting at 10% each year. Total that up to get the present value of cash inflows. Subtract my initial investment of $1,000, and I get a net present value at 10% of $78.80. Okay, so it's not 0, and we need it to be 0 or really close to 0. So I got to try again. Now I know that I have to increase my discount rate in order to get my net present value to be lower, right? Because we need these present value interest factors to discount these cash flows more sharply so that our net present value will be closer to 0. So I'm going to try a different discount rate, and I'm going to jump up several this time. So here this time I try 15% to see what happens. So now I'm showing the present value interest factors at 15% for years 1 through 4, and using the same cash flows we had in our original problem, I'm multiplying to get the present values, summing them up, and now I have a present value of $991.67. That's the present value of the benefits, minus my initial investment of $1,000, gives me a net present value at 15% of negative $8.33. So I'm obviously much closer to that 0, but didn't quite hit it. I overshot it just a little bit. So let's just back it up and try 14% and see if that gets me to 0. Alright, so here I am at 14%. I go through the same exercise again, only this time using present value interest factor at 14% for each year, and lo and behold, I'm over $8.11. So really, you can tell it's smack dab in the middle. The internal rate of return would be 14.5%. Okay, that's where the net present value would be 0. So for your purposes, you don't have to get the fractional percent. If you told me it's between 14 and 15%, that's good. You can interpolate and get the exact percent, but that's not necessary. As long as I have 2 consecutive numbers, that works. So the internal rate of return is between 14 and 15%, and actually since 14% gives us an NPV of $8 and 15% gives us an NPV of negative $8, we can judge that it's going to be actually just right in the middle at 14.5%. So how do we interpret that? Well, that tells us that if you invest in this project, then you should expect to earn a 14.5% rate of return. So the internal rate of return is to a project as a yield to maturity is to a bond. Okay, so before when we were talking about finding the exact yield to maturity of a bond, this is the process you would have gone through. Instead, you're finding the yield to maturity on a project. Except for a project, we happen to call that an internal rate of return. Now, do we like this project? Well, it depends. If 14.5% is greater than your cost of capital, then yeah, we like the project. So let's say our cost of capital is 10%. If this project yields 14.5%, then we're 4.5% ahead, right? So it would add value to the firm. If the internal rate of return is less than the cost of capital or the cost of funds, then that means it's not earning enough to cover its project cost plus the cost of financing. So we would want to reject the project if we could, because implementing that project would actually decrease the value of the firm. Here I'm showing you a shortcut that's completely optional. If you have a project that has annuity cash flows, meaning a project that gives you the same amount of benefits every single year, then there's a really quick way you can calculate the internal rate of return. You don't have to go through that trial and error process. So this is just optional if you want to use it, or you can just go through the trial and error process that I just showed you. But this could turn a 5 to 10 minute problem into a 1 minute problem doing this shortcut. So I'll just give you a short example here. If you have an annuity project where your net benefits are the same every single year, then finding the internal rate of return is simply a two-step process. First, you would calculate the payback for the project, and then you would look for that payback in the present value interest factor of annuity table, where N is equal to the life of the project. So in other words, if the project has a life of 10 years, you would go down to 10 periods and move across the table until you see the payback number, and whatever interest rate that's under, that would be your internal rate of return. Sounds more complicated than it is to work through one, so let's work through one so you can see it. Okay, so here we have an annuity problem. So the internal rate of return for an annuity, we have a net investment of $42,000. Okay, in return for that investment, we're going to get $14,000 a year every year for 5 years. So the other nice thing about an annuity, when you're calculating the payback, since your benefits are the same every year, you can just simply take your net investment and divide that by your annuity cash flows to get your payback. Now in this case, our payback comes out to a nice even 3 years, but that won't always be the case. So when you have an annuity cash flow and you're finding your payback by taking the net investment and dividing it by your annuity cash flow, make sure that you carry that out 3 decimal points, because you're going to be looking for that payback number in the table, and your table goes out 3 decimal points. So here we've got 3.000. Okay. Now keep in mind, looking at this project has a life of 5 years, correct? So now we're going to go to the present value interest factor of annuity table, and we're going to go down 5 periods and move across the table until we see 3.000. Well, when you do that, you'll see that you actually won't find 3.000. What you will find when you go down, you see where I've got ... 5 periods, you'll see 3.058 under the 19% column and 2.991 under the 20% column. So your 3.000 lies in between the two, a little bit closer to 20% than 19. So your answer would just be that the internal rate of return is approximately 20%, or you could say is between 19 and 20%. Either one of those would be correct. Okay, but it turns a trial and error problem into a really quick problem, and works only if you have an annuity cash flow. Finally, we want to do the profitability index. And the profitability index is helpful. It gives us some additional information. It's not used a whole lot in the real world, although it should be, which is why we're introducing it here. And in class, as we work through some of these problems, as you have questions, I'll be talking a little bit more about the benefits of the profitability index there as well. But the profitability index, you'll notice, is very, very similar to the calculation that we did for the net present value. The difference between the two is with net present value, we took the present value of our cash inflows and then we subtracted the present value of the cash outflows. With the profitability index, instead of subtracting the present value of the cash flows, we're going to divide by the present value of cash flows. Only difference. So the profitability index is the present value of your net benefits, your net cash inflows, divided by the present value of your cash outflows, which is basically your initial investment. So if your profitability index is greater than or equal to 1, then what that implies is the present value of your benefits must be greater than the present value of your cost. So therefore the project is acceptable. If the profitability index is less than 1, then that's saying it's costing you more to invest in the project than you're going to get out of it. So you would hope to reject the project. And just like with the net present value, we are discounting by the firm's cost of capital. So to go through an example, we have project A that has a net investment of $42,000 and annual cash flows of $14,000 each year for 5 years. Sound familiar? Assuming the firm's cost of capital is 10%, what is the profitability index? So our benefits are $14,000 a year, every year for 5 years, so I can just use the present value of an annuity formula to calculate the present value of that cash flow, and that's what I did here, discounting at the cost of capital for 5 years. So the present value of my benefits are $53,074. So the profitability index is the present value of my cash inflows or my benefits of $53,74 divided by my net investment of $42,000, and I get an answer of $1.26. So the way we would interpret that is that for every dollar you invest in the project, you'll be getting back $1.26. So since the profitability index is greater than 1, that is a project that will add value to the firm. It would be acceptable. Now we're just going to really just touch on a little bit of the theory behind net present value and internal rate of return. And the reason we focus on those two is because industry prefers internal rate of return. They like using that the most because it's just more intuitive. Everyone thinks in terms of rates of returns, right? Before you took this course, I could walk up to you and say, this asset will yield a 10% rate of return, and that would mean something to you. If I walked up to you and said, this asset's going to give you a net present value of $1,000, if you didn't have any financial background, you would have no idea what I was talking about. So internal rate of return is just more intuitive. So therefore, that's one of the reasons, companies tend to gravitate toward the internal rate of return. However, in academe, we actually prefer the net present value because the net present value will always give you the optimal project. In other words, if you're rank ordering projects by net present value and you're rank ordering projects by internal rate of return, you can get a conflict in rankings. And if you go by the net present values, you will maximize the value added to the firm as opposed to going with the internal rate of return rankings. Okay, so let me go ahead and explain that. Now, there's two reasons why that occurs: because of the timing and the magnitude of the cash flows, and because of the reinvestment rate assumption. Okay, first of all, it's important to keep in mind that as I'm talking about this, I'm talking about acceptable projects, because you can be sure that anytime the net present value of a project is greater than 0, meaning it's acceptable, the internal rate of return will in fact be greater than the cost of capital. Okay? They will agree when it comes to whether or not a project is acceptable or whether it should be rejected. Okay, and that's what we mean by accept reject decisions. And actually, to further add to that, you can also be sure that the profitability index will be greater than 1. They will all three agree. as to whether or not the project is acceptable or not. Where you could get the difference is, let's say you've got 10 projects and you're ranking them from highest value added to lowest value added. Well, if you rank them by net present value and then you rank them by internal rate of return and you rank them then by profitability index, you can get different rankings. In other words, let's just say, for example, net present value may say you should go with projects A, B, and C. Let's say you can only afford to invest in 3 of the 10 projects. And so it says you should go with projects A, B, and C because they have the highest net present value. Internal rate of return might say that projects C, D, and E are the best. They're all good projects and they would all add value to the firm, but the net present value is going to give you the mix of projects that adds the most value to the firm. Okay, so here's where I want to explain why you can sometimes get a difference in ranking of projects between the NPV and the IRR. And please read this carefully in your book too, because your book does a really good job of explaining this as well. So first it has to do with the timing and the magnitude of the cash flows. So let's talk about that first. Here I have 2 projects, Project A and Project B. And you will note that they both cost $10,000, but you should also note something that's very different about the net benefits associated with both of those projects. If you look closely, you'll see that Project A has most of their benefits at the front end of the project, right? You get $6,000 in year 1, and then the cash flows go down to as low as $1,000 by year 4. Whereas with Project B, you start out slow and your cash flows become large later in the project. Okay, that's what we mean by timing and magnitude of the cash flows. If you have 2 projects where the timing and the magnitude of the cash flows are that different, right here they're almost perfectly opposite, not quite, but almost, then you're going to get a difference in ranking in those projects. Here you can see what's happening. Here we've got the net present value profiles for these projects. First question, what in the world is a net present value profile? Okay, a net present value profile tells you what the net present value is at every possible discount rate. So to construct this graph, what I did was I looked at the cash flows in the previous slide for Project A, and I said, okay, if the discount rate were 0, okay, if we don't discount the cash flows at all and just sum up the cash flows minus the net investment, here's what my net present value would be. If my discount rate is, say, 5%, and I discount the cash flows in the previous slide by 5% minus my net investment, here's where my NPV would fall, okay, at whatever dollar amount this is. If I discounted at 10%, here's where my NPV for Project A would be. This might be 15%, this might be 20%. I mean, I purposely left the numbers off because the numbers aren't important. I want to make a different point. So what the net present value profile does is it tells you exactly, it shows you what the net present value is for Project A at every possible discount rate. Because see where your discount rate is on the horizontal axis and your net present value is on the vertical axis. Okay, since Project A has its cash flows, has its larger cash flows up front in the beginning of the project, then when you increase the discount rate, the net present value falls at a slower rate because the cash flows that are farther out that are getting hit harder by the increase in the discount rate are the smaller cash flows, not the bigger ones. Notice with Project B, it's exactly the opposite. Remember, with Project B, you have your large cash flows at the end of the life of the project. So every time you increase that discount rate, those large cash flows are getting hit hard, right? Because your discount rate increases exponentially, right? Your present value interest factors increase exponentially each year. So the net present value profile for project B has a much sharper slope. It's going to drop much faster because of that timing and magnitude difference in the cash flows. So what happens here is we get what's called the crossover. So if you want to ask the question, based on net present value, which project is better, project A or project B, you can answer either one and possibly be correct. It would depend on what the firm's cost of capital is. Let's say that the firm's cost of capital happens to be 10%. Okay, and so let's say that right here, this point right here where my laser is, okay, so before we get to the crossover, this point right here happens to be 10%. If the firm's cost of capital is 10%, then clearly project B has the higher net present value over project A. Okay, so as long as the firm's cost of capital actually is less than this crossover point, then project B has the higher net present value over project A. Okay, what about the internal rate of return? Well, the internal rate of return, remember, by definition, is where the NPV is 0. So if we go along the axis here, you'll see here's the internal rate of return for project B. And if this is, let's say, 10%, maybe this might be 17%. Be some higher number, 17%. So let's say that project B has an IRR of 17%, and project A is going to have a greater IRR of, say, 22%. I'm just making numbers up, but 22%. So point being is it doesn't matter what the cost of capital is for the firm. The internal rate of return for project A is always going to be higher than the internal rate of return for project B. It doesn't change. Okay? Whereas with the net present value, again, if the cost of capital is less than this crossover point, which it was in our example, it would prefer project B over project A. So you'd have a conflict in ranking. Now on the other hand, if the cost of capital happened to be greater than this crossover point, then you don't have a conflict in ranking. Project A would have a greater net present value than project B. Okay, so does that make sense? So because of the magnitude of the cash flows, we can get a difference in ranking. The other reason is implicit in the calculations for the net present value and the internal rate of return, we are making a reinvestment rate assumption. If you were to go back and look at the net present value slide, you would see the formula for net present value, and you would see that we discounted by the firm's cost of capital, right? We took each of the cash flows each year and we discounted by the firm's cost of capital. Whereas if you look at the internal rate of return slide, you would see that we were actually discounting by the internal rate of return, not the cost of capital. So that implies two different assumptions. With the net present value, since we're discounting by the cost of capital, we are implicitly assuming that any cash flows we get from the project will in fact be reinvested at the cost of capital. For the internal rate of return, since we are discounting by the internal rate of return, we are assuming that any cash flows that come off the project are going to be reinvested at the internal rate of return. Okay, well, that really is problematic for the internal rate of return, because let's say that you have a series of projects. Let's say you've got project A that has an internal rate of return of 20%, and project B has an internal rate of return of 50%. Okay, that 50% internal rate of return is based on the assumption that each year when you get the cash flows from that project, you're going to turn around and reinvest those cash flows at 50%, at a 50% rate of return. Well, that very well may not be possible. So, and in fact, if you could reinvest at 50%, that's a pretty good rate of return. I'd say you'd be liquidating a lot of projects right now and throwing everything into 50%, right? So it may be an invalid assumption, but what's even more important is it means that when you're comparing internal rates of returns, they're really not comparable, because you're comparing an internal rate of return on a project that has a 30% return, and that 30% calculation is based on a 30% reinvestment rate, as opposed to a project that has an internal rate of return of 50%, which is based on a reinvestment rate of 50%. So that 50% internal rate of return may actually be inflated if you in fact cannot reinvest at 50%. So basically, the conclusion is that the internal rates of returns are not comparable. And again, I know that's kind of a hard concept to grasp, so please read that over again in your textbook. They talk about it there, and I can answer any questions that you have about that in class. Okay, so then that makes the internal rate of return reinvestment rate assumption really not quite logical, just because it's not comparable. With the net present value, every single project that you calculate the net present value for, you are assuming that you're reinvesting at the cost of capital. So you've got the same reinvestment rate for the net present value for every project, so therefore your net present values are in fact comparable. So this kind of summarizes what I said just a minute ago. The net present value reinvestment rate assumption is more realistic and also logical, because we can safely assume that any project that a company invests in would like to at least cover their cost of financing. In reality, occasionally we run into some projects that we have to invest in that doesn't cover our cost of financing, but most of the time we certainly do. So it is a much more realistic and logical assumption. That's not the case with the internal rate of return, okay, as explained in the earlier slide. One more problem with the internal rate of return is it is possible to get multiple internal rates of returns. Basically, I can just sum this up by saying that if you have a non-conventional cash flow, we talked about a non-conventional cash flow in the previous chapter, where you have a cash outflow, so you make a purchase up front, followed by a stream of benefits, and then you make another purchase, or you retool. I use the example of an auto manufacturer where they may spend money to retool, and then that's followed by another set of benefits. When you have a non-conventional cash flow, you do not get a correct internal rate of return. It basically messes up your internal rate of returns. You will get multiple internal rates of returns. And it's not really important to know mathematically why. I do have that on there, though, in case anyone was interested. Due to Descartes' rule of signs, what happens is you'll have a solution for each root of the problem, and so then each root each root will have its own solution. So it basically chops that cash flow up, and the internal rates of returns can't be added together or anything like that. So you get just internal rates of returns that are inappropriate. They'll be incorrect. So that is a problem. Another problem with using the internal rate of return. Net present value does not pose that problem. With net present value, it's very simple. Just keep working the problem as you would a normal problem. Just when you hit that other negative number, that other investment that you have to make, just keep the negative sign in front of it, but go ahead and discount it back and work it as you would a regular problem with that negative sign in front of it, and you will end up with the correct net present value. So at this point, we are done with this chapter. I'm sure you have some questions. Please, when I get back, I will look for those questions, so jot them down. If there's anything you want me to go back and explain again, I'll be happy to do that. Again, please read this portion, or read the entire chapter, but especially the theoretical portion for net present value and internal rate of return in the book, because as I say, they do a good job of explaining that as well. So have a good morning, afternoon, or evening whenever you're watching this, and I look forward to seeing you soon. Bye-bye.